Coming up in today's show, stocks bounce back from yesterday, Meta's blowout quarter, along with Amazon, a look at Apple's earnings, how far can the bull run, new banking turmoil, and how to invest in green hydrogen. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. And what an interesting day we've got here. Just had three of the biggest stocks on the market report earnings, most notable being Meta, currently looking at a 5-minute chart after hours, up over 14% as I speak, as they blew past expectations, also announced their first ever dividend, as well as increasing their buyback program by a huge $40 billion. All of those things are huge buy signals for the algorithms that largely drive the market, and that's why they've just absolutely piled on top of one another, lifting the offer after offer. And here we are trading at $452 a share. There's a look at the daily chart. We finished at $394 and we are already all the way up here, looking like we're going to gap up here around $450 tomorrow. Similar story with Amazon. They beat earnings expectations by 25%. Blowout quarter. Algos have jumped on this one as well. Currently up 8% after hours as I speak. And just looking at the daily chart, we'll be opening up around 172 tomorrow. Howard is looking at a monthly chart on Amazon, where we're currently trading now just above 170. That's still a bit below all-time highs of 188 in middle of 2021. And just looking at Apple, they came in with a marginal beat. EPS only surprising by 3.8%. Market's not really too excited. Initially rallied up a bit, then quickly got sold off. Currently off a touch here, down 1.2% as I speak. There's a look at the daily chart on Apple, which is now the weakest of the Magnificent Six stocks. And just looking at the Qs, Nasdaq after hours up 1.1%. We didn't take out yesterday's highs in the regular session today. However, we're looking like we're around 426 now. Probably going to gap up here tomorrow. S&P 500 up 0.58% after hours, currently trading around 492, which is an all-time record high price for the S&P 500. So what a flip from yesterday. After the S&P was down 1.6%, more so in the Magnificent Six. We finished down yesterday 2.7%, finished up today 1.7%, but the group as a whole currently trading up 4% after hours. So on this composite chart, we'll be looking like we're opening just under 2,000 tomorrow. The market's just so great at doing a gotcha, rug pull, bait and switch, flipperoo, whatever you want to call it. That's what it's done today. However, it's not all beer and Skittles out there. We do have some issues in the banking sector, namely regionals, which got whacked again today. Still got a bit of weakness in the oil and gas sector, and we still got a bit of a defensive rotation. Got the healthcare sector trading up, utilities having a good day, along with consumer defensives, and even industrials caught a bid there today. So the rise of mega cap tech continues. They continue just to blow past expectations with strong momentum in their businesses that's manifesting in their share prices. And Meta just absolutely smoked it. Fourth quarter net income, $14 billion, $5.33 a share, compared to $1.76 a share same quarter a year ago. Revenue up a huge 25% to $40 billion. Just amazing, these massive companies growing at these huge rates. Truly is impressive. And that's because they largely have monopolies on the industries they operate in. You know, Alphabet with search and video, Meta with social, NVDA with chips, and so on. Not only that, they surprised the market by initiating their first ever dividend, just showing how much excess cash the company has, in addition to increasing their buyback program. And they're able to give back all this cash to shareholders while continuing to invest into their Reality Labs hardware division as they look to be the future leaders in the virtual reality market segment. They've also been using AI to boost their ad targeting capabilities. And currently as it stands, advertising still makes up the lion's share of Meta's revenue, 96.5%. Let's look at the long-term monthly chart of Meta. One of the most dramatic turnarounds I've ever seen. Ripping up into late 21, came off with the rest of the market in 22, but Meta got punished extra hard by the market, actually fell 76%. As they were investing a lot into the metaverse VR, the market really didn't like that. They missed on a couple of quarters there. The Zuck recognized that and then called 2023 the year of efficiency and cost cutting, laid off a bunch of staff, replaced them with machines like a lot of them are doing, and here we are, currently up more than 400% off those lows. What an absolute rebound and bounce that has been. Truly impressive stuff. Same deal with Amazon, absolutely blowing past expectations, showing that the consumer and retail spending is still really strong. They reported $13.2 billion in income for the fourth quarter, up from $2.7 billion a year before. Analysts were thinking they were going to come in $10.4 billion. How far off were they? Revenue rose to $170 billion from $149, and they too are mentioning AI on their earnings call with their new AI assistant for shopping called Rufus, improve the customer experience, saying they had a really strong holiday season. Also, their cloud computing business, AWS, logged a 13% growth, and their ad services revenue also up a huge 27%. And there's a look at the monthly on Amazon. They had a less dramatic fall in 22 and a less dramatic bounce. And like I said, we're trading around here now, around 172. Still a bit away from those all-time highs. And you just compare that to Microsoft, which is well above its 2021 peak. NVDA absolutely head and shoulders above its 21 peak. Alphabet, similar to Amazon, still below its 21 peak. And Apple, surprisingly, got past its 21 peak June last year. It's been kind of hovering up there. But just look at this now. We're kind of selling off a bit more after hours as I speak, down 2.7%. And so even though they managed to put in their first quarterly earnings growth in over 4 quarters, it's only 2%, pretty slim gains. I think the market might be worried a bit about what's going on with them in China, really important market from them. Looking at fourth quarter, they came in 20.8 billion in sales from China. That was down from 23.9 billion a year earlier. Market was worried about sales from iPhone. Luckily, they beat expectations, coming in at 69.7 billion versus 67.6. Still, they don't really have any notable AI product. Still mostly a hardware business with the most amount of political risk from China as well. They still get a lot of their chips from Taiwan semiconductor manufacturing, a lot of manufacturing out of China, not to mention their sales there. It's back to the 5-minute chart. It's actually breaking down right as I speak now. Down 3.2%. The market's really not liking what they're hearing from Apple, and this could be another liquidity event allowing big money to get out of the way here. Whilst Meta's still holding up over 14% and Amazon's still up over 7.5%. These are some huge moves. And so what spooked the market yesterday was the language and tone coming out of Jay Powell. He really pushed back on the possibility of rate cuts in March. Didn't really definitively say that we're going to get a soft landing. Now we've got some like Bank of America saying we won't get that first cut until June, as Jay and his team are not ready to declare victory on inflation yet. Still got some things out there that could ramp it up, namely shipping costs, not to mention a strong consumer and economy, and a loosening of financial conditions the last couple of months with yields pulling back. However, we've still got some analysts saying the stock market is flashing a buy signal as the long-term bull market looks intact. That's the chief investment officer at Federated Hermes, saying the secular bull market that started in 2013 is still alive. The S&P could be on track to notch 6,000 after 2025. So we're in the mid stages of one of the 3 great secular bull markets of the last 100 years. Like all bulls, it's had its share of steep 20 to 35% corrections, but never more than that and never for too long. Also got some research coming out of BFA that the bull market in stocks still has more upside ahead because investors aren't feeling euphoric yet, with them saying we're not seeing levels of euphoria that bull markets typically end with. And that's their sell side indicator, which actually ticked down in January to 54% and is in neutral territory and well below the 59.8% peak it hit in 21. And there's a look at it there. You can see it peaking out in the late 90s, bottoming out in late 2012. And according to this indicator, we're nowhere near that kind of exuberance that's normally associated with market tops according to them. However, everyone's not so sure. That's the former bond king Bill Gross saying the US's $34 trillion debt deficit will drive inflation and worsen like global warming over the next 10 years. He said high US debt levels will become an alarming problem this decade. And the Fed could fund rising deficits, but this will only spur more inflation. Also got Wall Street's #1 man Jamie Dimon with similar feelings, saying mounting US debt will eventually spark a rebellion in global markets. That's because $7.6 trillion of US debt is held by foreign entities in countries like Japan and China. Going on to say it's a cliff. We see the cliff. It's about 10 years out. We're going 60 miles an hour. With them saying the US debt to GDP ratio looks like a hockey stick chart, or one that starts relatively sideways before eventually spiking. Expects the measure to hit 130% by 2035. Going on to say the hockey stick doesn't start yet. We kind of got time, but when it starts, markets around the world, there will be a rebellion. We've got others saying the Fed risks making a big policy mistake that could spark a 30% drop in the stock market over the next few years. That's Smead Capital, saying the Fed risks cutting rates too early, causing inflation to spike and investors to flee the market. Going on to say the Fed is on the cusp of making the same error it did in the 70s when the central bank saw cooling inflation and prematurely began to slash interest rates. That ended up being disastrous for the economy, plunging the US into a stagflationary spiral and eventually a recession. That obliterated stocks and was pretty much a lost decade for the stock market. However, it was a great time for commodities, namely oil and gold. We've got others saying we're due for a bit of a correction in the market. February is typically a seasonally weak period. Market has been on a 20% straight up rip. And just looking at election year seasonality, that's typically when we get the pullback, is February into middle of March. The last couple of years, the market's been following seasonality very closely. So it'll be interesting to see if this materializes as well. However, looking at the price action we're getting this afternoon, looks like we're ripping up to new highs again. And once again, we're getting that bifurcation in the markets. We got tech partying like it's 1999. However, we're seeing some issues building again in the banking sector after New York Community Bancorp. This is the bank that took over Signature Bank in March last year after they were about to go under, and they came in with a surprise and huge loss yesterday afternoon on their earnings, sending the stock absolutely tanking along with the rest of the regional bank sector. And that's because we've still got high interest rates and there's still some tail risks out there. A lot of these guys took in huge deposits in 2020. A lot of government stimulus, people were worried, so they deposited it into their banks. Banks couldn't farm that out in enough loans like they normally do, so what they did, in all their infinite wisdom, is they bought long-dated bonds at 250-year lows in yields. Of course, yields have rocketed. They didn't think inflation would come back. It did. Now they've got these huge open mark-to-market losses on their balance sheets, which is okay if they can hold them to maturity, get their principal back. However, if they have to liquidate, then that could set a chain of events that could ripple throughout the whole system. Not to mention the issues in the commercial real estate sector haven't fully played out either, which is another sector the regional banks have big exposure to, having financed a lot of it. And so while the market seemed pretty optimistic there today, that wasn't the case in the regional banking sector. Down a healthy 3.1% on more than triple average volume. And there's a look at New York Community Bancorp. A couple of days ago, it was trading over $10 a share. Here we are at $5.75. Not to mention a bunch of those other kind of vulnerable regionals like Western Alliance down 7.5%, Zion 6.3%, and a little bit less First Horizon down 2.3%, and even the big guys didn't escape that selling today. They all kind of ended a bit lower here. And so even though Jay was trying to talk tough on inflation, doesn't really want to say when he wants to start cutting rates, that fell on deaf ears of bond traders who are continuing to send yields lower here today. We also just had initial jobless claims rising to a 3-month high. Jobs market's still holding up, it's kind of ping-ponging back and forth. We did see fourth quarter productivity rising at 2.7%, and purchasing managers index, PMIs, manufacturing actually back into expansion territory. The economy's still holding up really well, but looking at the 2-year government yield, it's just holding ground there at 4.2 in lows, and the 10-year as well, actually dipping down to 381 today. So the market still thinks there's going to be weakness warranted enough for Jay to start cutting rates probably in May, because right now they're giving about a 62% chance they'll be on hold in March. However, it's a 96% chance they're going to cut in May. And it's just an interesting dynamic in the market. We've got tech absolutely ripping higher. Now we've got the regional banks tanking, worries about commercial real estate. If the banking crisis there stays contained and inflation keeps coming down and the Fed is able to cut rates without anything massively breaking, then that's just going to be more fuel for the tech semi-AI sector, because then their cost of capital, relative attractiveness of stocks versus bonds is going to go up. Whilst they've got no problems, their business is still ripping higher. The only risk is if what's happening in banking blows up enough and spills over enough to affect the whole economy and sentiment of the market, including tech stocks. So that's a theme we'll be watching play out over the next couple of months. It'll be interesting to see how that all unfolds. Just moving on to commodities, we've got oil pulling back again today. As there's signs we may be getting an Israel-Hamas ceasefire deal, trying to cool tensions over there. And this is something the US and diplomats have really been pushing for, trying to get Israel to pull back. They don't want to see a larger regional spillover and a spike in oil. It's going to hurt Biden's chance of re-election in November. So they're trying to get the Israelis to pull back, work out a peace deal, whilst at the same time deterring Iran with a proportional response to their continued attacks on US bases and global trade and shipping. Of course, Iran knows that. Question is, are they going to play nice? Or do they want to see oil spike going into the US presidential election? As maybe Iran, Russia might prefer Trump back in the White House opposed to Biden. As it's unknown whether Trump will support further continued war and spending of US tax money in Ukraine and the Middle East. Looking back at his track record and what he did in his first term, he actually prefers to negotiate and keep more money at home. So this could be an interesting dynamic if Iran want to keep poking away and maybe has to pull Biden into a bigger conflict going into the election and could get oil spiking, and that could upset inflation and his chances of being re-elected. And just moving on to my special today, I wanted to show you guys, and that's hydrogen, small segment of the clean energy sector. I think it's quite interesting. And before I get into it, first let's just start off with the basics. What is hydrogen? So on the periodic table, it comes under H. It's the lightest, most abundant, and one of the oldest chemical elements of the universe. Most of the universe is made up of hydrogen, and it's not to be confused with hydropower, which is one of the oldest forms of energy and pretty much just uses gravity of water, typically from a reserve, free-flowing river, stream or something. The water falls down and the energy from that spins a turbine into a generator, which is then transformed and sent back to the grid in electricity. Hydrogen is the process that is mostly used with gas, adding oxygen and steam to then split out hydrogen cells. Very clean form of energy, and it does have a part in the future of clean energy. However, it's still very, very early days, still very costly. However, it does have many applications, namely in transport, lots of industrial uses, and it's better stored than wind and solar, which comes and goes. And so unlike gas and batteries, hydrogen can't be used directly for energy itself. Rather, it powers what's known as fuel cells, which we're already seeing in some cars. And the advantage is, unlike batteries, which have short distance, and then hybrid vehicles, gas, diesel, biofuels, they're kind of like a mid-range. Hydrogen is really good for long distance. That's why we've seen it in trucks and used by big companies like Amazon and that for delivery. However, what I'm more interested in is green hydrogen. Hydrogen can be made, like I said, mostly from gas, grey hydrogen, coal, brown, and black, and any other fossil fuel. It's blue hydrogen. However, green hydrogen is when you use renewable energy to split water from oxygen and hydrogen, and that's the cleanest type. That's green hydrogen. And so I'll just show you this little introduction to green hydrogen. This is from Fortescue Group, ASX listed stock, which I'm going to get into a bit as they're making big inroads into green hydrogen, and this will give you a bit of a better explainer into what it is. Okay, so there you have it. That's green hydrogen. And it's basically by using things like hydro and wind as the energy source used to split water into oxygen and hydrogen. And that makes a hydrogen gas, which is easily compressed and stored and can be transported anywhere in the world for domestic or industrial use. And so the problem at the moment, it's very costly, especially compared to other sources. It's still very early in the terms of technological development. However, some research houses like Precedence have forecast huge growth for the green hydrogen market, currently only around $6-7 billion. How within 10 years, that's expected to explode to over $134 billion. And I think like nuclear, this is going to be part of the overall pie that helps power the world and its determination to get off dirty sources like coal. And just like nuclear, when the world's leaders are opening up to green hydrogen, with even people like the US Energy Secretary, Jennifer Granholm, saying clean hydrogen is the Swiss Army knife of zero carbon technologies. If we can get it right, it can do just about everything. Okay, so we know hydrogen, especially clean green hydrogen, highly likely to be a part of the future. What are some investment options in it? And first, let me just start off by having to say that this is not financial advice. Please do your own research. I'm just presenting to you my research and different investment options for exposure to the hydrogen space. And here's looking at the biggest ETF in the space, which has only got 34 million assets under management, just to give you an idea how tiny this space is. And it really is the smallest kind of sector of the clean energy space. Completely different from nuclear, wind and solar, lithium, EVs. However, just looking at the main clean energy ETF, PBW, the whole clean energy sector has come off a lot in the last couple of years. And just going out to a monthly chart and zooming out, you can see it had a huge run up into 2007, big speculative bubble there. GFC brought it crashing down. It's bottomed, had a huge run up in the cheap money era of COVID, huge amount of financial speculation, bubble and top, and the whole clean energy sector has come off more than 80%. Hydrogen included. So let's just look at some of the stocks and ETFs that give us exposure to this. And let me just first off start off by saying it is very speculative space. It's still very early days. It's going to remain highly volatile for a long time. So any positions in this space should be small in one's portfolio and willing to accept a high level of volatility and uncertainty. So we'll be looking at a few stocks coming out of the Eurozone, America and Australia. The first being Nell, coming out of Oslo in Norway, 8.92 billion market cap, that's in euros. And it's pretty hard to find a pure play hydrogen company, especially green hydrogen. Apart from some tiny ones, there's nothing really out there. However, Nell, pretty close to being a pure play in hydrogen. They produce, store and distribute it. They've been around for some time and their revenues have been growing each year. Still not really cash flow positive, but they almost hit $1 billion in revenue recently, and they too been beaten down off their highs. Coming out of France, really small one, McPhee Energy. Only 76 million market cap. Small revenues, but are growing. They engage in the development and provision of hydrogen-based solutions. Products include electrolyzers to help split hydrogen, refueling station, storage, and integrated solutions. They trade on Euronext. Coming out of New York, small and once again highly speculative company, pretty much a penny stock here at 79 cents. Hyzon Motors, 193 million market cap, only got a little bit of revenue, and they're a hydrogen mobility company. Their purpose is designing, developing, manufacturing both standalone and integrated hydrogen fuel cells, as well as purpose-designed hydrogen-powered commercial vehicles. And there's a look at their website, and like a lot of these smaller EV companies, they kind of specialize in kind of purpose-built products, and for big companies that want delivery, long range, efficiency, meeting all their ESG goals, this can be some products they look at. However, once again, let me just underscore how speculative this company is. It's not a sure thing. Likely to remain highly volatile if they are able to stay in the game. Another one coming out of France, Life, 259 million market cap. Don't really have much in the way of revenue. Once again, highly speculative, small company. They engage in the production and supply of renewable hydrogen. And they too are focused on renewable hydrogen, clean hydrogen, and they can help supply that for station operators, transport companies, freight transport, logistics, and a bunch of other industrial industries as well. That's a good thing about hydrogen. It has really wide use applications. It's good to store. It's just not cheap to produce right now. Moving on to the States, to a few some of you may be aware of. The first being Bloom Energy under ticker BE. Coming out of California with a 2.69 billion market cap. They're a bit further up in the hydrogen supply chain. Got good growing annual revenue. And they're in the business of manufacturing and installing fuel cell-based power generation products. By converting gas into electricity. And so remember, to use hydrogen, we need fuel cells that mix the hydrogen with oxygen to turn it into energy, and they only emit water as waste. That's the biggest part of the market now, is these fuel cell companies. And that's the same deal with Ballard Power Systems coming out of Canada with a 1 billion market cap. Revenue's been a little flat, and they develop and sell fuel cell products that again can be used across a wide range of different markets, namely transport. Another one of the biggest ones coming out of America, I'm sure a lot of you know, Plug Power, 2.85 billion market cap. Nice steadily growing annual revenue there. And they're probably the world's leader and biggest, kind of closest thing to a pure play on green hydrogen. Once again, developing fuel cell products, and they actually have some big customers, and they're partnered with my favorite in the space, Fortescue Group, coming out of Australia. However, Fortescue are not a pure play on hydrogen. The bulk of their business is actually iron ore. That's why they got a market cap of 91.9 billion. However, it's for that reason I think they've got an advantage, because they've got a hugely profitable cash cow of an iron ore business, selling mostly to China, the world's biggest user of steel, the end product of iron ore. Got a fat dividend yield of 5.8%, still reasonably valued, less than 13 times trailing earnings. And that's headed up by who I consider Australia's #1 businessman, Andrew Forrest. Nicknamed Twiggy, one of the country's richest people, grew Fortescue from nothing to one of the world's biggest commodity companies, and he is betting big on green hydrogen, using his ample cash flows to get in the business, as he has inspirations of being a world leader in the space. Even saying things like he's betting his net worth on mega green hydrogen plans, making big investments in the space. Like I just said, they're partnered with Plug Power, probably the leader in green hydrogen, and they've dedicated a whole division in his business called Fortescue Future Industries, as he wants to evolve his business into a clean energy one, using his huge iron ore cash flows to help finance it. And that's what I think gives them the advantage, because a lot of these other companies, they're struggling with cash flows. Even Plug Power, it's very hard to make money on green hydrogen now because it's still such very early days. And so this could be a decade-long theme, just like nuclear, and this guy has the cash to keep investing and funding it without getting slammed down by the market. And that's why we can see Fortescue, going out to a monthly chart, is the strongest performing of them all. That's because thanks to a resurgence in iron ore, and it's just an extremely profitable business. They've got a market cap of 91 billion, and last year reported net income of 7 billion, one of the most profitable companies in the world, and he's putting all that towards his goal of becoming the leader in green hydrogen. And that's why, to me, it's my favorite long-term pick for exposure to this sector. However, less risky, as always, is ETFs. And there's two. The Direxon Hydrogen ETF, very small, 26 million. It's got 31 holdings related to the industry, almost half in America. Reasonable expense ratio of 0.45%. And there's a look at some of its top 10 holdings that it's got in the fund there. Coming in slightly bigger is the Global X Hydrogen ETF, 34 million assets under management, 26 holdings, a very reasonable 0.5% expense ratio for a niche ETF. And there's a look at its top 10 holdings. Plug Power coming in the biggest at 13.5%, followed by Bloom, Nell, Ballard, some of the ones I just covered. And so there we have it, guys. There's the look at hydrogen, a space I'm going to be following for many more years. But once again, I just can't reiterate enough how risky, early stage, volatile and uncertain a lot of this industry is. That's why any positions in this one should be a small one, especially with this downward momentum. Probably haven't seen the bottom yet. If not, a bottoming process could take many months, if not a couple of years to form, like we saw in uranium. However, this is likely to be an important part of the future when it comes to clean energy along with nuclear. And that's it for my coverage now for hydrogen. Come back tomorrow. I'm going to look at the other areas of the clean energy after I did nuclear yesterday. We'll take a bit of a look at other parts of clean energy tomorrow: wind, solar, lithium, and clean energy technology as well. And just moving on with the rest of the show as we're going into OT here. So look at breadth there today. Bouncing back, 296 stocks and ETFs breaking out to 52-week highs, led once again by Super Microcomputer. A little bit of a bump up in securities hitting 52-week lows, 87 today. There's a look at the VIX index, falling back below 14 today. Nice bounce back in TLT, back above its 50-day VWAP on volume with those falling yields. And those yields could be adding a bit of downside pressure on the dollar, back below 103. Bitcoin still tracking sideways just below 43,000. And gold starting to inch higher and higher again, maybe coming back to test these all-time highs from this big red candle here at $21.50 an ounce. There's a look at crude. We fell a bit there today on volume, just sitting right at the 50-day VWAP, $74 a barrel. A little bit of a bounce back in China. International stock indices were largely flat for the Thursday session. Looking at stock sectors, it was actually gold junior miners the winner today, followed by retail and home builders, still one of the most strongest sectors in the market. And contrasting that big time, like I just showed you, regional banks really going the other way of the market today. Big kind of divergence there. My top 10 ETF picks for this year had a pretty good day. Nice breakout on the Cannabis ETF. Now trading at the highest we've seen in months to go back to late 22. That's looking really good technically. And just a look at the portfolio of my top 10 ETF picks that I gave you guys late last year. Portfolio as a whole is up 2.2%, just slightly ahead the benchmark Global 60/40 ETF. And my number one pick, Cannabis, now up 43% year to date. What a rip it's having. And just checking in on these large mega cap tech stocks that just reported, there's Apple, still down 3.2% after hours. Microsoft's trading up a little bit. Same with Alphabet. Amazon, still holding ground there, up almost 7%. NVDA's loving the action, trading up as well, 1.5%. And the real standout of the day, Meta, holding ground at $4.50 a share, up 14%. Zuckerberg just gave those huge buy signals to the algos, smashing earnings, increasing guidance, new dividend, increasing buybacks, buy. There's a look at Tesla, no longer in the magnificent group, now that it doesn't have $1 trillion market cap like the rest of them do. There's a look at the Super Microcomputer, just continuing its rip after it delivered a blowout quarter as well, and getting a nice move up there from Ford. We get to hear from them on the 6th with their earnings, see if they can match General Motors' good result as well. Alright guys, that's a wrap for today. Looks like we're going to gap up pretty big there tomorrow. There's the Magnificent 6 as a group, up 3.8% after hours, trading at all-time highs thanks to the absolute blowout quarter from Meta. And what an absolute turnaround that has been over the last year. Got to hand it to Zuck. He has defied the critics and the street, and him too has a very profitable business that can finance his future push into the metaverse and virtual reality. So things are looking very good there for them, along with Amazon, not so much on Apple. So we'll see where they all open up tomorrow and the price action we get to finish out the week, along with probably the second most important economic data we get for the month after CPI. That's the non-farm payrolls jobs market report we get every first Friday of the month. See how the market reacts to that and where that comes in. And I'll also take a look at the rest of the clean energy industry. After I covered uranium, nuclear yesterday, hydrogen today, we'll look at the rest of this sector tomorrow. Thanks very much for tuning in, hitting that like button, and I'll see you again tomorrow night. Cheers.